They said it couldn't happen. Triple-digit silver, a fantasy. The shorts were covered, they told you. The chaos was over and the market had calmed down. Rational again. But today, Friday, January 23rd, 2026, that whole narrative exploded. Not slowly, not quietly. It collapsed like a dying empire, fast, loud, and all at once. That infamous $90 price wall, it didn't just crack, it shattered. And when silver hit $100, there was no hesitation, no breather. It shot past like that number never mattered. As of now, silver's sitting at around $103 an ounce. Read that again. Say it out loud. Your brain might not believe it the first time. $103. This isn't your typical slow, steady climb. This is the market in reverse freefall, an elevator cable snapping upward. But here what should really make you pay attention, even if you don't own a single ounce of silver. This price jump? It didn't come from a mine disaster, breaking news from a war zone, or a surprise announcement from a central bank. No single headline explains this. That's what makes it so unsettling. It's not news, it's momentum, it's fear. It's the moment the market collectively realizes, hey, the ceiling's gone. And once that happens, welcome to what traders call price discovery. Sounds tame, right? It's not. Price discovery is just chaos wearing a suit and tie. It's when nobody agrees on what fair value means anymore. For years, silver traded like it was boxed in, stuck in the 20s, then the 30s, the 50s, the 80s. Each level lasted long enough to feel like the new normal. But today, the final anchor snapped. And now, we were left asking a much bigger question. What does 103 silver actually do to the real world? Industrial buyers, think solar panels, electronics, medical tech, are suddenly facing costs they didn't plan for. And they can't just pretend it's not happening. These costs either get pushed onto you, the consumer, or they stay on the company's books until something breaks. And then there are the short sellers. If you bet against silver at $80, thinking prices would drop again, you're now down $23 an ounce. Multiply that by big institutional bets, and the losses aren't just bad, they're potentially devastating. And here is the catch with short selling. The pain doesn't just stop until you close your position. And closing means buying back in, which means you're now part of the demand in a market that's already overheating. So ask the question that the mainstream avoids because it's too uncomfortable. What happens when those who sold promises to deliver silver now have to chase the price to survive? That's the spiral, the no exit trap. That SY 103 isn't our T a finish line, it's just a marker on a runaway track with no brakes. But maybe the most important part of this story isn't even playing out in New York. It's unfolding in Shanghai, where real physical silver is being traded, and the numbers coming out of there, they're not just higher. They're breaking the system that sets global prices. This is more than a price surge. It's a rupture, and it's far from over. If you were concerned about the gap between New York and Shanghai when it was just a few dollars, take a deep breath, because it's no longer a gap. It's a canyon. Shanghai just closed around $123.40 an ounce. New York, still hovering near $103. That's a $20 difference. At this point, it barely feels like the same asset is being traded on both sides of the world. In a normal market, that kind of spread should disappear in seconds. Algorithms would jump in, buy low in New York, sell high in Shanghai, and the price difference would smooth out. That's how arbitrage works, at least in theory. But here's the catch, that theory assumes something big, that you can actually get your hands on the metal, move it, and settle the trade without major issues. What if the real problem isn't shipping time, but that there's just not enough physical silver to go around? That's what this spread is shouting. It's not a signal to buy the dip or play the premium. It's a warning. The market is telling us that the New York price is becoming more symbolic, a reference, while the real physical price is being set somewhere else. And that changes the game completely. If someone in Shanghai is paying $123 for silver, they can hold right now. Why would anyone sell their supply at 103? Here's what that looks like in real life. Delays, rising premiums, allocated only purchases, and that all too familiar phrase, 6 to 8 weeks. Sounds like no big deal until you start hearing it from every seller. That S when you realize people aren't T-buying silver, they rebuying a promise to maybe get silver later. They think they're locking in a price, but what they're really doing is joining a waiting list. Now zoom out. Look at where the metal's flowing. From London, New York, and Zurich toward Shanghai, Hong Kong, and Singapore. That's not just a trade. That's a shift in trust. It is a global move to secure hard assets in a world that S looking shakier by the day. And this $20 spread, it's more than a number. It's a warning sign that the link between paper silver and real physical silver is coming undone. And if that link breaks, the ripple effects won't stop with silver investors. It'll bleed into manufacturing, banking, currencies, even geopolitics. Now, quick pause. If you are into this kind of analysis that focuses on the mechanics behind the headlines, hit like, subscribe, and stick around. Because the story unfolding here, you're not going to get the full picture from cable news. So here's the big question. Is this just about silver? Or is silver the first to crack and reveal something deeper? Because when you look at today's markets, you don't see stability. You see a system desperately trying to stay upright, while the foundation beneath it starts to give way. 6 hours after silver shattered the $100 barrier, it's clear we're not just looking at a commodity rally. This isn't about silver anymore. It's a full-blown market melt-up. Everything's rising all at once. Gold is charging toward $5,000 an ounce, making moves in a single day that used to take a week. And stocks? They're green too. The S&P is up, the NASDAQ is up, the Dow is hitting fresh highs. Pause and really think about that. In a normal market, fear assets like gold and risk assets like tech stocks don't rally together. But this isn't normal. This is what it looks like when the system's measuring stick, the currency itself, starts losing credibility. When money weakens, everything priced in that money seems to go up. Good assets rise, mediocre ones rise. Even the junk gets a lift. Not because they're suddenly worth more, but because the dollar, or whatever unit you're using, is quietly worth less. That's how you end up with a market that looks strong on paper while people feel weaker at the grocery store. It's the illusion of wealth backed by a shrinking wallet. And the bond market, that's where the cracks get harder to ignore. Yields are spiking, bond prices are falling, and suddenly the cost of just servicing government debt becomes a front-page issue. Play that out. The U.S. debt is massive. When rates go up, the interest payments explode. That forces the government into a corner, either slash spending, hike taxes, or turn to the printer. Historically, the printer wins. It's the easy button, less painful in the short term, but devastating over time. Markets aren't dumb. They see this. They sniff out the next round of printing before it happens. They price it in. And when enough people believe more money will be created to handle rising costs, the spiral begins. Higher rates, higher debt costs, more issuance, more printing, weaker currency, higher prices. Rinse and repeat. So ask yourself, are assets actually going up, or is money just going down? That single question flips the entire story. It changes how you see silver's surge. It explains how gold and stocks can rally side by side. It shows why commodities across the board are revaluing, not from growth, but from decay in the value of the currency itself. It also shifts the emotional tone of the market. In a slow decline, people adapt. They adjust. But in a fast one, they panic, they scramble. That's why silver's breakout doesn't feel normal. Not because silver suddenly became magical, but because confidence is no longer steady. It's jerking, it's wobbling, and markets are reacting with the urgency of a stampede, not the calm of a trading floor. And here is the strangest part. The one asset that S spent the last 15 years branding itself as the escape hatch from currency collapse isn't acting like it. You probably know which one I mean. And that silence? It might be the loudest signal of all. For years, the pitch was clean and convincing. Bitcoin is digital gold. It's the modern hedge. It's what rises when traditional money starts to fall apart. But today, the story hits a wall. While silver surges, gold climbs, and even stocks ride the wave higher, Bitcoin is red. On a day when nearly everything else is glowing green, it's sitting in the corner, down. And that contrast matters. Not as a jab at crypto or its tech, but as a window into how people behave under real pressure. Because when the system wobbles, really wobbles, people don't run to what might be money one day. They reach for what has always been money. They go for what's tangible, proven, and familiar. Silver isn't just a precious metal. It's a conductor. It's used in solar panels, medical tools, electronics. It exists in the real world, in atoms, not abstract ideas. Bitcoin, for all its brilliance, lives in code. Revolutionary code? Yes. But code that depends on electricity, networks, exchanges, and trust in systems still evolving. And when things get shaky, the market gets primal. Atoms bits, at least for now. This isn't the end of digital assets. It's not a death sentence for Bitcoin. But in this chapter, this moment of rising physical premiums and weakening currencies, the crowd is voting with its fear, and it's voting for what it can hold. There's something else we need to talk about, though, and it's uncomfortable. Bitcoin has behaved like a risk asset for years now. It's been tracking like a tech stock on steroids. When liquidity is flowing, Bitcoin flies. But when confidence in the system falters and people start pulling back, Bitcoin can stall or fall. Silver, on the other hand, it doesn't need hype. It has two built-in engines, industrial demand and monetary fear. That's a sturdy combo when storms start forming. And make no mistake, the clouds are building. So here's a deeper question, and I want you to really sit with it. If we re-heading into a world where trust fractures, where paper prices say one thing and physical goods tell a very different story, what becomes the ultimate reserve? Is it the thing that's easiest to move or the one that's hardest to counterfeit? When people are truly afraid, what do they reach for? Convenience or certainty? Drop your thoughts in the comments because this goes way beyond silver. This is about where the next version of the monetary system might be built and what we all choose to build it on. Now take that question and carry it over to a corner of the market most people ignore, currencies. Because silver isn't exploding in a vacuum. It's not happening just because. It's reacting to the real backdrop, the US dollar quietly losing altitude against everything that actually matters. And when the dollar, the world's measuring stick, starts to slide, the entire picture changes. While headlines are busy celebrating a shiny metal crossing a round number, the deeper, more important story is hiding in plain sight. The dollar is weakening, and fast. The dollar index is sliding toward levels we haven't seen in years, and this isn't just a blip, it's a signal. It's what happens when global investors start pricing in currency risk. When the world looks at mounting debt, ballooning deficits, and political gridlock, it begins asking the uncomfortable question, can this trajectory be reversed without breaking something else first? Once that question starts spreading, it feeds a dangerous loop. A weaker dollar pushes investors to dump bonds. Bond selling sends yields higher. Higher yields make debt more expensive to service. That stress increases the pressure to do what's easiest, print more money. And this loop doesn't need a villain. It just needs a system built to avoid pain at all costs. That's why the Shanghai price spread is more than a quirk. It's haunting. It is the physical market saying loud and clear, we don't trust the paper price anymore. And once the physical world stops accepting screen numbers as reality, things don't reprice cleanly. They fragment. You get delays, sudden premiums that don't fade. They become the new price. You get two parallel markets, one for investors chasing exposure and one for people demanding actual delivery. That split, once it becomes culturally understood, can widen faster than any government or central bank can react. So what do you do with this? As a viewer, an investor, or just a person trying to protect a life built inside a system that might be shifting? You start by taking the emotion out of it. You get mechanical. You ask, what do I actually own? An asset or a claim? What risks am I carrying without realizing it? Currency risk? Counterparty risk? Liquidity risk? Have I been ignoring those risks just because the old system taught me to? Volatility isn't a glitch in transitions like this. It's the main feature. So instead of chasing price targets, focus on principles. Ask yourself, if the measuring stick keeps bending, what kind of assets and what kind of decisions still make sense? This isn't financial advice, it's pattern recognition. History shows us that when confidence in money starts to crack, people gravitate toward things that are scarce, essential, and hard to replicate with a keystroke. And that brings us to the final, and maybe most urgent point. The gap between Shanghai and New York. It's not just about price, it's about trust. That spread isn't just dollars left on the table. It's credibility leaving the room. And once trust breaks, it doesn't tiptoe back in. It snaps, it runs, it disappears. So I'll leave you with this. If global markets are starting to split into two realities, promises versus possession, where does the real price go? Does paper chase physical until the system converges again? Or does physical detach entirely and build a whole new pricing center of gravity? And if that happens, what breaks first? The contracts or the credibility behind them? If you want part 2 of this story as it unfolds in the next 48 hours, hit subscribe, because we may be witnessing more than just a violent repricing. This could be the first chapter of a brand new monetary era.